I'm Matt Bouchard with REIT.com here in NAREIT's headquarters in Washington, D.C. Joining me today is Hans Nordby, Managing Director with PPR. So Hans, now that we're about to end 2012, let's put a bow on the year. What do you think has been the most significant development in the industry this year?
Well, the most significant development for the economy in 2012 was what didn't happen, Matt. And that was the implosion of Europe, which is instead sort of the slowest moving train wreck that's ever happened. So we'll be watching this thing, I think, for another 5 years, knock on wood. If we're only watching it in 2013, then the big thing that happens is a recession. So we're really hoping that we can keep plowing down that road. Other big things in 2012 were the housing market recovery, which is not going to be 03 to 05, but it is a source of some growth, and it's not a boat anchor anymore. Other big things we take away for commercial real estate is I think this year, 2012, was the peak year for apartment rent growth. So we expect it to be almost as strong in 2013. But if you're waiting for that big pop, that was it. So that's kind of done. So that was big news, big apartment rent pops. And that's because 2 years earlier, we had the recovery really start in earnest in the apartment rentals, and supply has only just started to kick in.
And you have a lot of interaction in your job with the pension plan community. How would you sum up their current attitudes towards REITs as an investment alternative?
Well, there's positives and negatives for plan sponsors in terms of investing in REITs. In general, I think the temperament there in that community is mixed, but generally trending downwards and away from REITs. Not overwhelmingly and not amongst everybody, but if we're trying to take the temperature of the whole industry. A number of reasons for this. First of all, everybody experienced a lot of volatility with their portfolios. From 06, we had a little upside in 06, through some bad news in 09. And that's true with public and private, REITs and private real estate. But across the board, plan sponsors want to decrease the volatility of their portfolio, and they want to increase their control over the outcomes. So, in terms of the private funds, they want a decrease in leverage, and they want pretty focused investment guidelines from private funds. So even there, that's being felt. And in REITs, it's just very difficult for a plan sponsor to steer the way a REIT behaves, as it should be. That's the type of vehicle that REITs are. So what REITs are doing is they're opening more separate accounts, they're buying the properties individually, and they're decreasing the leverage on them. What is very interesting for REITs, and is increasingly in REITs' favor, is for really two categories of institutional investors that smell a lot like the plan sponsors that you mentioned. So those would be foreign investors who oftentimes really like the liquidity and the ease of taxes with regards to investing in REITs, big positive situation for REITs. And then also for endowments and foundations. And small pension funds like local police or fire departments, sort of the guns and hoses crowd. So for them, because they have smaller increments to invest, to be able to invest in REITs gives them some liquidity and exposure to a lot of things without a big checkbook.
And last question, a bit of a hypothetical. If you were a new investor to commercial real estate and you were given a large allocation of capital and you had to invest it in a specific U.S. market or a specific U.S. property sector, how would you put that capital to work? In
terms of what we would recommend in our optimal portfolio right now, we would say it's probably 20% or so REITs in their total real estate allocation for diversification and for some liquidity. And then versus the property types, the public versus private, now we're going property types, we're going to underweight office just a little. We're hitting the sweet spot for NOI growth really out in 14. So you're starting to take more of a view, but it's still tough going overall in office. I'm speaking very broadly. Apartment, we're going to go just a tad overweight, but we're watching the submarkets pretty carefully. Supply is kicking up, and it's kicking up in a lot of the real investor favorite markets that are thought of as high barrier. So good and bad, we got declining home ownership rates, good demographics, but you really got to pick your submarket. And then in retail, we would go a little underweight. The percentage of the universe is about 29%. You're probably in the low 20s. But I would say that It's a nice contrarian play right now. And then finally, warehouse, which is a wonderful fit for institutional investors. Low volatility, high yield versus other property types, and lower capital expenditures. So it's not a good over 50 years long-term rent growth play. You get some functional obsolescence, but for a cash generator, it's a perfect fit with low volatility. So that's kind of where we would tilt the portfolio. And we do this all the time for lots of folks.
Great. Well, Hans, thank you so much for your insights.
Thank you.
For more on this and other REIT news and analysis, be sure to visit REIT.com.